No business owner makes tax mistakes on purpose, but between the complexity of the tax code and using your CPA for after-the-fact tax advice, mistakes happen, and opportunities, frankly, are frequently overlooked. The top mistake is just that, not engaging a tax professional before it's too late to act. Once the clock strikes midnight on December 31st, ball game over. There's very little you can do to impact last year's taxes. So at the very least, if your company is a calendar year, meaning December year end, spend December to get a handle on where you are and what you might be able to do between now and the end of the year to do whatever it is you need to do. Show greater profits, create a loss, and minimize your taxable income. A second is not maximizing retirement plan contributions. Very common, especially amongst a startup business. Now there's two sides to that. The first is not maximizing the contribution within the context of the type of retirement plan that you already have. But the second is maybe it's not the right retirement plan. There are other types of retirement plans beyond 401ks, IRAs, or SEPs that might give you much greater flexibility in how to make that contribution. A really big one, especially in the last few years, is misclassifying employees as independent contractors. Now, of course, you know why startup businesses do that. They don't want to withhold payroll taxes, and generally it just costs them a little bit less money. But the IRS and the states now actually have a fairly long list of criteria that will help you distinguish between an employee and an independent contractor. In addition to the tax consequences of calling someone a contractor versus an employee, there could be liability problems as well. If you're classifying someone as an independent contractor, that means you don't have workers' compensation or maybe other insurance that you probably should have on them. And if there's a problem on the work site, that could cost you big time. Mismanaging your company's tax status can also cause problems. Whether you're a C Corp or an S Corp or an LLC or a partnership or a sole proprietorship, paying attention to what you should be is going to make sure that you make fewer mistakes and give you the best tax outcome. Another problem that's really common is owning your real estate inside the company. Now, and if you own the business and you own the real estate, I get it. You want to have them all in one place, but that's not the right way to do it. You should have them in separate entities. Your company entity here, your real estate in a separate entity here, and you treat yourself just like any other landlord would treat you. So it's got to be arm's length with a lease, and there's lots of flexibility in that, again, to impact your tax situation very favorably. Another issue is improperly structured buy-sell or continuity agreements between the partners. Improperly structured could mean that it's old, the valuation clause doesn't work, there's no funding for it, whether it's through life insurance or a sinking fund or whatever it might be. But also, it could be that you've got a stock redemption agreement instead of a cross-purchase agreement. And that gets pretty technical, but just understand that there's more than one way to skin that cat. Another issue is if you're buying equipment, should you depreciate it or write it off? The tax code is fairly liberal and allows you to write off up to $250,000 under today's tax code for equipment that you'd buy in any 1 year. So if you're in a low tax bracket this year, you probably don't want to write it off immediately, and you probably want to spread that out over its useful life, maybe 7 or 10 years. Conversely, if it's December and you have a big honkin' tax gain ready to happen, well, maybe it would make sense to buy your January equipment right now in December and write that off this year to minimize this year's taxable income. Getting taxes right is an imperfect science, and you'll never get it right every single year. But paying attention to these 7 issues and working closely with your accountant or tax professional before the year's end is going to save you a lot of time and trouble in the long run.